Welcome to the Emotional Balance Sheet, the go-to podcast for parents with multiple kids, especially those with twins, triplets, or more, who are navigating the maze of modern family life and personal finance. Whether you're overwhelmed by education or retirement planning, parenting dilemmas, career transitions, or trying to define your purpose and plan, we're here to guide you with empathy, encouragement, and expertise. Hosted by Paul Fenner, founder of Tama Capital, a certified financial planner and parent to 4 kids, including a set of triplets, our podcast is your ally in the quest for financial peace of mind, proving that money matters, but family comes first. Subscribe now and join our community of empowered parents at tamacapital.com.
This podcast is for informational purposes only and should not be relied upon for investment decisions. Clients of Tama may retain positions in the securities discussed in this podcast.
What does comprehensive financial planning even mean? At Tama Capital, it means a family office where lifestyle planning such as retirement, college, portfolio management, tax prep, and planning all are under one umbrella. But it goes beyond numbers. We focus as much on the emotional side of financial planning as we do on the financial side. We get you. We understand your challenges of building a family, business, or career, and a healthy life. We are devoted to wealth planning for families like yours because we are you. Learn how our family can help your family by visiting tamacapital.com.
Allison Schrager is an economist and writer who has taken on this incredibly complex and, in my opinion, unique subject of risk in her work. I probably came across Allison's work 7 or 8 years ago. She has an amazing Substack subscription that she writes on. But the one thing I love about Allison is that she has this flair for engaging in storytelling, especially in her book, An Economist Walks into a Brothel, which we'll get into. But Allison really seeks hard to debunk commonly held myths around risk and challenging this mantra of no risk, no reward. She probes into the subtleties of risk management and emphasizes that while society often chooses to ignore the inherent trade-offs of pursuing greater risk, or greater rewards, I should say, acknowledging these risks is critical for successful investing, but as you will soon learn or hear, it's even more important in life itself. Please enjoy my conversation with Allison Schrager. Allison, thank you so much for being on the show. I know you get inundated with requests like this often, so it's a real privilege to have a conversation with you. The reason why I've been following your work for so long and reading your book, An Economist Walks into a Brothel, which we'll talk about, is how you talk about risk. And I know in my situation as being a financial advisor, I've really tried to redefine how I see risk and talk about risk with the families I work with. And so I think that's a really good place for us to start, this conversation, is for you to talk about maybe some of the common misunderstandings around how you define risk and really how we measure it.
Yeah, I mean, I'm glad you bring that up because that's the book I'm working on now, is like 7 myths about risk. And, it's not one of the myths I get into, but it's I think one I debated, which is, you always hear, no risk, no reward. But for some reason, we're in complete denial that is true. Consistently. And I almost would call that a risk that it's not true, because it seems a myth that it's not true, because I don't know if it's just human to deny that there are trade-offs. And if you are going for more, there's risk that comes with it. And that's just a fact of life. And I mean, I think that was also what I was trying to impart with Economist Walks into a Brothel, is that these trade-offs exist. There's ways to manage them. especially once you acknowledge they exist. But I mean, it's just a fact of life that, and it's true in any aspect of your life, not just markets. I think I love financial markets. I love studying them because I think they provide a really sort of clean way to illustrate these larger truths, because it's just like things being bought and sold all the time in such a high volume that sometimes these things become a little bit more clear. But I think sort of realizing, and I think this is at the heart of, like, if you think about it, every single financial scam, which people are always very concerned about, is someone's offering them a really high return and no risk. Like, once someone offers you that, it's a scam. It's really easy. If someone manages to de-risk your portfolio, that's going to come at some cost, be it, premium, be it just, giving up on some returns, you're hedging. So I think that's the number one thing. Anyway, it sounds so obvious, and it's actually like a cliche to say there's no reward, but it seems to be something that we, even really financial professionals. I mean, think of all these sort of financial professionals who got involved with Madoff, all should have known better. And I think it's just so tempting to think that you can get more for less or get a high return for no risk.
My good friend Brian Portnoy has said this, and I'm sure Morgan Housel said this as well. But investing, there's always going to be a certain part of your portfolio that you're going to hate.
Mm-hmm. Totally.
And it's
doing it right.
Yeah, if you're doing it right, there's always a portion of your portfolio that you're going to hate. Because when the market's ripping like it has been, at least in the Magnificent Seven this year, you want to be all in on those. But then just literally 14 months ago, those stocks were in a 70% drawdown and no one wanted to own them. So it's very interesting. And I didn't know that. I knew you were working on a new book, which we'll get into. I didn't know what the title or what the theme of it was. So this is going to be apropos. When I talk about risk with the families that I work with, I think there's this overwhelming idea that it's about markets. It's, did I under or overperform the benchmark, or what the S&P 500 did, or whatever it is. And I've really tried to twist that definition and view largely based on the work that you've done, and come back and say, no, well, that's important. The real risk is, how is it impacting your overall financial plan, whether it's short-term, medium-term, long-term? Like, what's the risk of you really achieving or not achieving your plan? That's the risk that we should really be focused on and measuring. Yeah,
I mean, I've been thinking a lot about, I think of as the original sin in financial planning, which is when we moved from defined benefit to a defined contribution world. And I think I discussed this in the book, we more or less we had financial strategies which had grown up over the years for people who had significant family wealth. But in terms of the average person, the average person just wasn't in markets for most of their history. So when all of a sudden, half of Americans own stock, we sort of took that same conventional wisdom for people who had significant family wealth to individuals, which, they are saving and investing for very different reasons. They're not looking to leave a bequest. They're not looking to just have this huge pile of money sitting there. They're actually saving and investing to fund their consumption throughout their lifestyle. And that's a very different objective, and that requires a completely different strategy, and also a different way of measuring success with your portfolio, most importantly. But we're sort of applying not only the same strategy, but the same success metrics that you would do if you were managing a hedge fund. And and I think it just really sets everyone up to fail and makes your communication with your clients so much harder than it needs to be. Because they're always going to judge you. If you're being responsible, you're thinking about long-term, you're thinking about diversification, the Magnificent Seven. I mean, we're completely different 30 years ago, but you're thinking about people's wealth for decades. So if you were just not thinking about risk, you would just invest in those 7 stocks and go home. And they would be able to, all your clients could say to their friend, hey, my guy is doing better than your guy because I'm making more money. But that's not your job. Your job is to provide, meaningful income and wealth to these people for their lifetime. And investing in 7 stocks does not achieve that.
I was just having this conversation with another financial advisor colleague, Matt Reiner, and we were kind of sharing the same struggle about how hard and difficult it is to get people over this idea or hurdle that your financial plan is more than just your portfolio performance, and the ability to look at risk. And risk is all around us. And it goes back to, I think, being able to make healthy trade-offs, healthy decisions, looking at opportunity costs. Because again, again, as we said before, if we're doing it right, there's always going to be a portion of your portfolio that you're going to hate. Whether you're a 90-10, a 60-40, a 50-50, it doesn't really matter what your asset allocation is.
Yeah, and I'd add a corollary to that whatever portfolio is that you hate changes over time. What you love today, you're going to hate in 5 years, 10 years, or maybe even next year, and vice versa.
So when I was having a brief conversation with my wife this morning, Teresa, about who I was having on the show today, I said, her name is Allison Schrager. My wife, sorry, did not know who you were. But I said she wrote this really interesting book years ago that I really got hooked on, and it's called An Economist Walks into a Brothel. And she looked at me, she's like, what is that about? I said, it's all about risk. That was like my big takeaway. So can you talk us through how you came up with the book, the idea, and I guess as importantly the title, because it's really super catchy.
Yeah, it's a lot of pressure because you'll never top that.
Right.
I'd spent years, I did a PhD in retirement economics, in economics, so I specialized in retirement and economics of retirement. And then I spent years building financial products with really brilliant financial economists like Merton and Fama, and learned a lot about how to reapproach the retirement program, really more from a financial than macro perspective. And I learned a lot about finance, I guess. And I'd always kept up this side career writing. And so it sort of reached a point where I felt like people didn't understand these basic principles of finance and investing. It's really not, I won't say it's not hard. It's hard and it's not hard, but there were some basic principles that could make people's lives a lot better if they understood them. And I don't think a lot of people who were writing either didn't understand them or weren't in a position to communicate them. So I figured I'd sort of do for finance what Freakonomics did for applied micro, because I felt like that book was super important and that it really changed how people saw economics, that we weren't just stock pickers, that economics is a story about incentives and trade-offs. And it really helped educate people because it was fun to read, illustrate what economists do. So I figured finance needed that treatment. And so then I had this idea that I was going to do Freakonomics, but for finance, because I knew a lot of finance. I knew how to write. This would be easy. And then it dawned on me when I sat down to do the project, I didn't have the research papers that Steve Levitt had to draw on. But I did have experience as a journalist. So I figured I would just report stories and I would meet people and, share their stories. And the idea was that, as I said, I think risk is everywhere and in our personal lives and in every market. Financial markets are just one illustration, but financial markets are the clearest one because there's just the large volume of transactions. And risk is explicitly being bought and sold, although it's implicitly being bought and sold in every other market. So I figured I'd show how every market deals with risk in a similar way. But then I also realized, as someone who'd only written opinions about the economy, I also had no idea how to report, and I had no idea how to find these stories. And this is actually quite hard. And so I was talking to, I was really in the depths of not getting anywhere on my book proposal. Everyone said this is a great idea, but the execution was a problem. And so I was talking to a cousin of mine who has a bit of an unsavory side to him. And he was a lawyer though. So I was I'm really trying to do this book and I need a good story, a good risk story. I don't know how to find one, but you're a lawyer. Do you know anyone who's ever committed a crime? And he mentioned that his girlfriend ran an illegal online brothel. What was interesting about it is that she was, so most sex work I wrote about the legal brothels in Nevada mostly, but most sex work in America happens online. Like there's websites where sex workers advertise and, you correspond with them, you set this up. I mean, it's very dangerous though. I mean, some, guy who wants sex is like sex workers. I mean, it's the whole thing's sketchy. I mean, it's sketchy for the customer. It's sketchy for the provider. It's a very dangerous job. So there's all these things sex workers do to verify that this is an actual person, that they're not going to be violent. And on the customer side, there's also ways of screening. So it turns out his girlfriend effectively did the screening, which is actually quite arduous and difficult and kind of puts pressure on the relationship. So she effectively removed risk, or like a lot of risks, from this transaction. And for that reason, she got 1/3 of the money. And I was like, oh, this is an interesting risk story, because it's like you remove risk from this risky transaction, you get 1/3 of the revenue, which, like, there we go. There's a risk premium. And I'm always looking for the way risk is priced in markets. So I wrote this story I was at Quartz, and it did well, as you might expect. And then I got an email from the Bunny Ranch. They had a rather sort of wonderful guy I stay in touch with, aggressive PR guy, because the legal brothels can't advertise, so they're always looking for media attention. Less so now because they don't really have an industry leader after Dennis Hoff died. But anyway, so they get in touch with me, and he's like, well, if you're going to write about brothels, you should write about us. Why are you writing about this no-name woman in New York who has like 5 people when we are like the biggest and best brothel? We're like the Goldman Sachs of brothels. He didn't use that, but that's what he said. There was a snobbery there that you see,
because they had their own TV show, right?
Yeah, I mean Dennis really like understood that marketing was important, and because you can't advertise, he took every opportunity. So I was like, I don't write about brothels. I write about retirement, but hey, I'll get on the phone with you because this is interesting, and why not? And he explained to me how it all worked. And he said something really interesting. He says, he said a lot of interesting things, but one thing stuck out was, we don't have set prices. Every transaction is individually negotiated because the women work as independent contractors. And I was like, oh, that's interesting. So you're telling me you have these like 18-year-old women negotiating with like rich men in their 60s? Like, he's like, yeah, no one's ever asked about that before. These women come here, they don't really know how to negotiate. They don't really know how to ask for their value. So we have a negotiation training program.
What?
And, yeah, which caught my eye, because like this is not just true in sex work. This is like a thing that like women have problems asking for how much money they're worth, and when they do, that's perceived as aggressive or hostile, and like it's a big deal. It's a big thing in every job. So I was like, and you think about sex work, like, I mean, I'm always nervous about asking for more money because you have to work with these people later. But like, I mean, they're gonna like have sex with these people. It's even more awkward. So I had this wonderful, wonderful editor at the time at Quartz, Lauren Brown, and she was like, you got to go with the videographer. And so I sort of just like invited myself. I was like, I would like to come and view your negotiation training. And I'm bringing a camera woman. And they were like, cool. So off I went to Nevada, and I said, I'm still struggling with this book proposal. And went through the negotiation training program, which was excellent, by the way. And
who did they have running the negotiation training program?
It's really like a one-on-one mentorship. So
I think of negotiations, and I think of Chris Voss. I've also had I'm looking at my bookshelf. Gary Nesner, who was an FBI negotiator at the Branch Davidian compound in Waco. I have had him on. So I think of like negotiator. I think of like those people. So I'm like, who does a brothel bring in to help train their?
Well, I mean, so Dennis, who owned the brothel, he's since died. Dennis Hoff, like the famous brothel owner. Before he ran the brothel, he had a timeshare business, and it sounds horrible, but it was sort of brilliant. His realization when he decided to get into the brothel business that sex work was a lot like the timeshare business, and he was really good at running the timeshare business.
Like once you get in, you can't ever get out.
Oh, yeah, I mean, yeah, that's actually a different story, but kind of. So, but also like training these people who sell people in timeshares and how to convince people to spend more. I mean, these are skills he developed very well. So he went into and really looked at every one of these women as individual providers were effectively like the sort of people who sell timeshares. So he gave them a lot of training, the same way they would train you in business if you decide to be someone who sold timeshares. So there were like weekly staff meetings with a lot of advice. And when they join the brothel, they are assigned a mentor who is instructed to teach them in negotiation. I think there was, don't quote me on this, a notebook with tips on how to negotiate. And they would do practice sessions all the time. So there was, I said a lot of training around this, and I sat on the practice sessions, got the mentorship, saw the notebook. It was, but it's really like all the people you were citing, all that conventional wisdom, like Dennis had studied that over the years from his timeshare business. So he knew all this stuff and like sort of distilled it down, made it more relevant to sex work. And there you go. So as I'm going through negotiation training, I'm also learning a lot about how sex is priced and how certain sex transactions are priced and why one thing's more expensive than another. And I really started to see another risk story there about how the brothel sets prices and how it varies from prices you would see, say, in the illegal market, which is more risky, because brothel sex is a lot less risky, or like really effectively no risk, because, they take all these steps to make for health, for violence, all these things. So, I mean, even if you're a customer, there's like no way anyone would ever find out. They even like take steps to preserve anonymity. So it really dawned on me there's another risk story there. And, this is when I'm writing the proposal. So it all kind of came together. I mean, to be clear, the book is not about brothels. There's one chapter.
Right. I actually wanted to point that out, because I think with you telling the story, which I think is a great story. That's why I really wanted you to share the story. But like in the book, like that's just one example. And one of the notes that I had down that I wanted to talk about was that when you think of risk, like so far we've talked about brothel risk, obviously we've talked about market risk, but when I'm working with families, I'm really centered on other risks like career risk, relationship risk, social risk. Like there's no shortage of risk. And I think that's the thing is like when people come to a financial advisor such as myself, they think, okay, well, they're just focused maybe on the portfolio management risk, if you will. But what I kind of really try to open people's eyes to is, well, your biggest asset is not your house. It's not your portfolio. It's your career. So what are you doing with your career? And what are you doing with your relationships? Because divorce is one of the most expensive things to go through, especially if you have, kids. Like most people know that I do. I have a set of now 13-year-old triplets and an 11-year-old plus one. So it's crazy. And then, social risk, like with social media, it's like you get something posted out there and it's not necessarily like endearing. So there's no shortage of risk. And what I try to get people to think about is, how do all of these risks come together to formulate not only your financial plan, but your lifestyle plan as well? Because this saying probably gets really old, that there's more personal finance than financial planning and financial planning.
Yeah, I think that people who've never seen planners discount that value add, but it's super important. One, because I mean, you are teaching that. I said also the original sin of financial planning, but the other big thing is what you point out is that for an individual investor who doesn't have like a trust fund, most of their wealth, particularly when they're young, is human capital. What we call in life cycle finance is like your future earnings, which is an asset like any other asset that needs to be managed. It needs to be you need to take some risks sometimes, you need to pull back on risks other times. And as I said, like even you say socially, I mean, there's also upsides to being well socialized, like, to networking. I'm terrible at networking, but like apparently like, being well socialized has a lot of financial upside too, in terms of like growing your human capital. So, I mean, I think that's when huge advantages of financial planners is they can sort of educate you on this more holistic way to think about your portfolio when, particularly if you're young, like 95% of it is tied up in human capital. And also, I think also thinking about risks people don't see. I've always felt like one of the huge values of financial planners is to also have hard conversations as you're approaching retirement. Things like, one of you might be mentally impaired. How are we going to think about this? Like, I mean, there's no way AI is ever going to have that conversation with someone effectively. Or
Right.
I hope, because that's a very dark world if you're having that conversation with a machine.
Yes, very much so. How did you get so involved in risk? Like, how did risk become like Allison Schrager's thing?
Well, I mean, I started doing retirement economics, I guess, when I was like 21 in college. It fascinated me as an economic problem. Because it is I was always loved economics, and economics' main question is, the scarce allocation of resources. And so retirement is sort of that. How do you have a finite amount of resources you're going to have over your lifetime? As I said, sometimes it's wealth, sometimes it's your future earnings, but it's finite and you have to make it last. And so that was the original thing that drew me in. It's a very rich topic too, because obviously there's a lot of things that come up, Social Security and all of these things. But then as you get into that problem, you realize it's first and foremost a risk problem. And not only that, like the original risk problem, I mean, humans from the dawn of time have been trying to figure out how to make resources last when they're faced with all these sources of uncertainty. I mean, now obviously these uncertainties involve markets and how long you're going to live and what's your health going to be. But I mean, even when you think hunter-gatherer days, this is like, how do we make, our food last despite all these sort of sources of risk? So it really is the most human and fundamental of all problems. So I think that's what drew me in, because it's not like economists think about a lot of problems, but this is one, the most fundamental, and two, impacts everyone everywhere. And in some ways is a very seductive problem, I think, as well as an economist, because, there's a lot of problems you can take on. But like development economics, that's hard. I don't think we'll ever figure out how to make poor countries rich, but the solutions to retirement are actually not that hard. We know what works. So no, but we will never do that. So you can have a very nice career being like, do this and you're right, and no one will listen to you. But really,
every day.
Yeah, as I got more serious about it, as I said, did a PhD and then 7 years of working with Merton, you do realize it is first and foremost a risk problem. And there are things you can do about that. We're not hunter-gatherers. We have a lot of, in a lot of development, economic development was driven by ways of managing risk of making resources last. So we come up with tools every day to make risk management easier or cheaper. So I think that's just exciting to me. And I guess that's how I became a risk person, because, once you do, you just see everything as a risk problem. I don't know if you're involved in economics Twitter. I hope not, for your sake.
No, I never got on Twitter. I love economics, but I have this love-hate relationship with yesterday, usually I don't talk about Fed speak on a podcast because most people are like, I don't know what the hell you're talking about, Paul. But yesterday was very interesting. I was driving in my car quite a bit, and so I was listening to Bloomberg and everything going on with the Fed decision yesterday. So I keep a pulse on it, but that's as far as I go.
You're a happier person than I for that reason. But there's a big debate on economics Twitter, and I even use economics Twitter lightly because I think of economics Twitter as a bunch of economics professors. So this is more like Nate Silver and some other guy, but they're in the world. So economics Twitter world. So they're having a huge debate because no one can figure out why, if the economy is so good, unemployment's down, inflation's coming down, interest rates apparently are going to go down. I don't know if that's true, but whatever. We're going back to everything we knew and loved about 2019, only even better, that everyone's so unhappy.
Right.
And so if you're thinking from a risk perspective, this is really obvious to me, and I keep writing this and it doesn't catch on, so I guess it's obvious to anyone else, which is, think about it. We've had like 30 years of inflation being low and predictable, right? Now inflation came back. It might come back again. Like, it's in the ether. Like, even if it's going down, maybe we're going back to 2019 and we'll forget this whole thing ever happened. Or maybe we're now in an environment where, like every other time since we've had dollars, where inflation is this pervasive thing that goes away and comes back, goes away, comes back. So think about it this way. When you have an uncertain inflation environment, it means your dollar, what that can buy, is riskier, because you just don't know what you can afford in a year the way you did in 2015. So think of, if an asset is, all else being equal, an asset that has a riskier flow is worth less than that same asset that has certain flow, right?
Right.
So if you don't know what your dollar can buy, even if your inflation expected is 2, but the variance around it is now, I don't know, 2 or 1, and before it was 0, like, you've just had a pay cut. Even if inflation is the same, just because you have uncertainty. And therefore, everyone just had a huge pay cut because they now live with inflation uncertainty. So even if inflation goes back down, but it's variable for the rest of time, like, they're going to be upset. People had a couple of years where they went to the store and eggs were $7. And now they're like, oh, I can't count on eggs being $3 anymore. So it's just one big, like, huge pay cut everyone's had. And I don't see why that's hard. Like, obviously, they feel like they're worse off because they are in risk-adjusted terms.
You actually started writing about this on your Substack, I don't know how long ago. And it's something that I keep in my mind all the time when I'm making decisions or having conversations with families, because usually, like, my annual review season is from September through the middle of November. And, I've worked with about 60 families currently. So small sample size, but enough where, the thing I love about my firm, TAMA, is, like, I have clients across the entire spectrum, from young kids to, people that are retired. It's a great sample size, but that's the one thing that I've really picked up on is the negative sentiment that people have. Like, they feel like it's really harder to get ahead these days because, yes, the rate of inflation, the cost of goods has been slowing down. But when you go back and look at your example of eggs, well, eggs used to be $3 and now they're, $7, and they're not increasing as much, but it's still a lot more than I was paying, 3 years ago.
Mm-hmm. Yeah. Or you don't know if $7 eggs are going to come back.
Right.
So it's like, so your future income, even if it's the same salary, it's just risky. It's a riskier stream. And because, economists always think of, it's not the money, it's what you can buy with it.
Right.
You can buy with it is more uncertain. It's worth less. It just is.
Yeah. I was just rereading, oh gosh, the book's like over there on the other side of the room. God, I can't believe I'm blinking on his name. But the point is that he was reinforcing the point that it's all about purchasing power. And when designing portfolios the way that I do, I always keep that in mind because, even I think there's this idea that, okay, well, once somebody hits retirement, then you got to go like ultra conservative. And that and I push back on that because no, if you have this uncertainty around inflation, buying, a bond that's, now obviously rates are high now, but rates were close to 0 for, a long period of time. And so with that, it's like, you can't, just shift your portfolio into conservative fixed income when it's not going to keep up with inflation, because every year you're going to lose.
Mm-hmm. Although I am enjoying the 5% I'm getting on the money market fund.
Oh my God. Yeah.
I hope that doesn't go away. I hope we keep that.
Yeah, that would hopefully but I don't know. I hope so too. But when I was listening to Bloomberg, Tom Keene was on, I was like, man, with what Powell did yesterday, I'm like, those rates are coming down pretty quick.
Are they? I mean, like, I feel like I'm invested in because I've made so many calls that rates aren't going back down, or maybe they'll go down, but not all the way down. But I don't know. Like, everyone now seems like completely on board with this idea. Like, this was all just an aberration, and we're going back to 2019 world.
Yeah, and I'm with you because, like, readers, full disclosure, Allison has a Substack read, which we'll link to in the show notes. Which I don't miss every week. Like, that's one newsletter I make sure I read every week. Allison, is yours. And I really, again, like this idea that, inflation may be coming down now, but it could always pop back up. And I think that's that uncertainty, that risk, like everybody's just expecting it to just go back the way it used to. What happens if it doesn't?
Yeah. And, I mean, granted, I've always been wrong on this, but like every economist I speak to is like, just doesn't see us going back to that world, or effectively that world was never sustainable.
Right.
And, I mean, certainly just like a zero rate world and, or a zero inflation world. And like the pandemic just accelerated these long running trends that spoke to sort of a more volatile, higher inflation environment, higher interest rate environment. And, maybe especially if we have a recession, we will go back down to those things like low rate, low inflation, but they'll eventually go back up just because structurally, how can they not? But you never know. I mean, as I said, understanding risk is like saying like, this is what I'm concerned about, but I ultimately don't know the future. I'm just preparing for everything.
Right. And I think the one thing that I try to keep in mind is with people wanting like lower rates or rate cuts, like, let's face it, at 6-7%, 7% mortgage rates, it's really killed the housing industry. But if the way I see it is, if the Fed starts cutting rates, something bad has happened in the economy, or growth is like really slowing, which is not great. So everybody like hoping and wanting these rate cuts. I'm like, well, wait a minute, does that really make sense? Like, because like in my mind, I'm like, something had to go wrong, and that's the thing, is trying to predict what that thing going wrong is impossible. It's just something will break.
Yeah, I think they're saying, and like the idea that we have this precision is absurd, that like rates right now are restrictive. So let's just go to neutral, but we don't have to like put the foot on the gas. But I mean, it said like we have so much uncertainty. I mean, who knows? I think the dot plots are consistently been wrong. So now that they're now predicting three rate cuts next year, I said we just don't know. And I said, granted, I've been expecting inflation and higher rates for like 15 years. So I've been proven wrong before. So take it for what it will. But as I said, you just look at the structure of it. And I just don't see how eventually these things don't come back.
So to bring, because I know I only have you for a little bit longer, to bring it back to risk, what do you think people miss most when dealing with their own personal risk?
You mean like in their life or in their finances?
I'd say let's go with life, because that's what I deal with a lot, is life planning, not necessarily like financial planning.
I mean,
I do both, but
plan, like the new book explores why I feel like most people probably aren't taking enough risk. And probably in their careers, in their maybe in their finances. I don't know. And that's harder to sort of say, especially for people who have planners. They probably are well invested. But certainly, I think also socially, I think we're seeing just so much more creep up of risk aversion. But we're also seeing it show up economically. I mean, there's this weird myth going around. And I mean, partially it was informed by faulty data I myself have used. So no shame in that people are living with this unprecedented economic risk, and it is just not true. I mean, wage variability has been declining for years, but you know what? So has wages. And it's sort of, as I said, it makes sense, right? If you're in a less volatile portfolio, you have less growth. I mean, so people are taking less risk in their jobs, so they have less wage variability, but they also have less wage growth. So I think people are largely now feeling like sort of like they didn't really give it their shot or meet their potential because they didn't really feel, and some of it, it's not their fault. I'm not saying everyone's neurotic. I think there are really truly structural things that make it a lot harder to take risk than before, but it is keeping people from being able to take the risks that they should and should feel empowered to take. And I think they miss out on a lot of upside, both probably personally and financially for that reason.
Do you unpack that a little bit in the new book with why people have a little bit? Can you give us any like teasers?
Well, I think some of it is, I think we've had like a lot of change and we confuse change with risk a lot. So I think when you have a lot of change, you naturally do pull back. I think two things really impact your relationship with risk, both wealth and technology. Because you think these are the two things you use to manage risk. If you have more wealth, you can pay to make risk go away. And if you have more technology, is a great tool to manage risk. So I think these things have changed a lot. So they've sort of distorted our view with risk. Also, as people get richer, there's evidence they become allegedly more risk averse. Although I find that relationship isn't clear. We got a lot wealthier during the early stages of the Industrial Revolution. Yet we also, it was actually a really sort of, in some ways, a golden era for risk taking was, I would say, the 19th and early 20th century. And we were getting rich like crazy. So I don't know if that's always true, but, so I think these have distorted things. I think there are also legitimately structural things. It's really easy for me to say to someone with, 3 kids and a steady job that, hey, man, you should try like going out on your own when like he's really dependent on health insurance from that job. And they said that's a structural thing we've designed our economy around that makes it really hard to take risks. So, I think there's policies and structure and I think culture. And as I said, I think just a general confusion from all the sort of change that's been happening.
So I want to get to the closing question that I ask all of my guests, which is, what is the best thing about being a parent? But I forgot to ask you before we hit record. I don't think you have kids, do you?
No.
So when I have this, I usually punt to my colleague Patrick O'Shaughnessy's closing question on his podcast, which I'm sure you're familiar with, is what is the kindest thing that anyone has done for you?
That's hard to say. So many people do such kind things for me all the time. I can't think of one. I mean, I guess I'd have to say things my parents have done, which is raise me. That was very selfless of them.
I can really empathize with that question, trying to raise a set of triplets plus one myself. Do you have a release on the new book, like when it's coming out? Anything?
I think January 2025.
Okay. So we got another year before we see it.
Yeah, I mean, it's actually written, but with the election and stuff, we've pushed it beyond that, which is in itself a risk. It's a book that's like arguing that the world has never been less risky, and like writing that a year in advance or 2 years in advance is in itself a big risk. Because I mean, we might have a recession then. We don't know what's going to happen with the election, but I'm just like saying now, yeah, the world's great.
Well, so I'll put a link to your book. An Economist Walks into a Brothel. It's a great read, everyone. And we only touched on one story in that book, and Allison lays out a plethora of great stories in there that revolve around risk that you'll find to be very personal for yourself. Allison, where's the best place for people to find you at?
Well, I mean, you can sign up for my Substack, which is sort of a digest of my writing. But I also, if you subscribe to Bloomberg, write for Bloomberg Opinion once a week too. All
right. Well, I will make sure that we put a link into for your Substack and your book. And again, I can't thank you enough for taking the time to have a conversation with us on the Emotional Balance Sheet podcast.
All right. Well, anytime. Thank you. It was a pleasure.
Thanks, Allison. Who knew how much we had in common with brothels? This is the thing I love about Allison's work and economist and behavioral scientist alike, is how they can take something as complex and as interesting or as deep as brothels and tying them into the risk that we endure in everything in everyday life. There's a couple of points I'd like them to talk about as well as I wrap up this conversation with Allison, is that we have to have this consideration of uncertainty and purchasing power when it comes to our financial future and financial planning. I think this is one of the things that I've really started to hone in on these last couple years, as we had nearly 20 years of no inflation at all, subdued risk, if you will. But now this is very real. While inflation is coming down, it's still relatively high. Like the prices that we paid a few years ago, we're probably not going back there. But the other point I think that's worth mentioning that we touched on is that this understanding why financial planning must transcend beyond portfolio performance and include not only risk management, but lifestyle management and planning as well. And again, I think this is a common theme I talk about all the time, about your financial life and your personal life intersect together. You cannot have one without the other. And I think this conversation with Allison really puts that into perspective. If you've enjoyed this conversation, could you do me a favor? Do you know anyone else who would enjoy these types of conversations where we talk about the intersections of our emotional and financial lives? Because if you do, it's actually going to help both of us. Could you share this conversation with someone? They will think you're great because you just gave them this terrific podcast, and it helps me grow my audience. Or you can tell them to go to tamacapital.com. Thank you so much, and we'll see you next time.
Thank you for listening to this episode of the Emotional Balance Sheet Podcast. Please visit tamacapital.com to subscribe to this podcast or to connect with certified financial planner and registered investment advisor Paul Fenner of Tama Capital. And please join us again next time on the Emotional Balance Sheet Podcast.